This video walks you through the solution to our semester-long case study, preparing the individual tax return for Monica and Chandler Bing. I set up this video to both walk you through the steps I took to complete the tax return, as well as provide validation of the answers along each step of the way. In the first step, you would have entered the taxpayer information for Monica and Chandler Bing. TaxAct, the software application that came with your textbook, has a default setting of single. Or if you enter two persons or two spouses, it automatically assumes married filing jointly. You should have selected the married filing jointly option when you entered the taxpayer information. Additionally, you also should have entered that they had full coverage through the employer for health care. This would have made a difference in computing the tax liability. Once you've entered the taxpayer information, you would have transferred the W-2 information to Chandler and Monica's 1040 form. This includes the salary and the tax information. In the third step, you'd have entered Chandler and Monica's other income. Here, the interest income that they've received from a bond from the Big Bank of Texas. The amount of interest income was reported on the 1099 INT form. In the next step, you'd have entered the income statement information for Monica's business. This information appears in both Schedule 1 and Schedule C, the self-employment calculation form. On the Schedule C, you'd have entered the net income from Monica's income statement of $380,000, as well as completed the cost of goods schedule, which appears way at the bottom of the form on line 42. In addition, you'd have entered the expenses from the income statement, including matching them one by one with a description on the form. These expenses included advertising, rental of other business property, supplies that weren't included in the cost of goods sold, taxes and licenses, utilities, and wages for the employees. A separate schedule appears at the very bottom of the form on line 48 to enter other expenses, which were $8,000. For Monica's business, these $8,000 comprise the uniforms for the wait staff. Under the tax code, uniforms for the wait and catering staff are an allowable business expense. However, Monica's professional attire was not. We also covered this topic when we talked about business deductions in Chapter 6. So, $64,179 of income ultimately passes from the New York South income statement to Chandler and Monica. This is effectively Monica's salary, since she doesn't take a salary throughout the year. We adjust this income amount from the self-employment based on the self-employment adjustment to arrive at an adjusted gross income of $209,723. Remember, the self-employment adjustment takes a portion of the tax liability out of the equation, because otherwise you'd have been double counting a portion of the amount calculated when you calculated Monica's Social Security liability, as well as when you calculated the business's Social Security liability. The next line on the 1040 form would have been the itemized versus the standardized deduction. What do we have from Monica and Chandler that could constitute an itemized deduction? Monica and Chandler paid property taxes of $82.11 on their primary dwelling. This could be excluded under the state and local real estate section of the itemized deduction. If they lived in a state wherein they also paid state income tax, this amount would have also been deductible. Monica and Chandler could deduct the interest on their primary dwelling space. This interest amounted to $11,947. What about the interest on their second home? This is another catch in the case. The interest on the second home was disqualified because Monica and Chandler used that mortgage to purchase cars for their children, not to improve a dwelling or acquire a dwelling. They could also deduct the $200 charitable contribution to Born Free in memory of Marcel. However, the running total of each of these deductions is less than $24,000, so Monica and Chandler are better off taking the $24,000 deduction to which they are entitled as a married couple filing together. We also deduct $11,929 as qualifying business expenses. This provision was passed as part of the Tax Cut and Jobs Act of 2017. Monica's business, as a catering business, meets this requirement. Now, Monica and Chandler have 2 children, and we know one of them, for a fact, meets the requirements for a dependent child. Erica, although she attends college, meets the residency requirement. She's younger than age 24 and an enrolled college student, and she was not married to anyone and did not file a joint return personally. But what about Jack, their son? Unfortunately, Jack is ineligible to be considered a dependent on Monica and Chandler's return. While he lives with the taxpayer during the year, meets the age requirement, and meets the joint filing requirement, he excludes himself because he is too old. Jack is 20 years old for this tax year, and he's not a college student. So unfortunately, Monica and Chandler can't count him as a dependent child. But let's look at the 2 additional requirements for a dependent relative. Monica and Chandler meet the requirement for providing the majority of Jack's financial support. However, Jack, as a year-round employee of Target Corporation, earns gross income in excess of the maximum specified by law. Unless Jack re-enrolls in college in the next tax year, Monica and Chandler can't earn the credit for him. Finally, we also have to enter the estimated tax payments that were provided on Monica's business income statement. We assume that she made these estimations based on her prior year work, and thus avoided the penalty from overestimating or underestimating on her quarterly tax payments. Once you compute all of those different steps, the overall tax liability, that is the amount that Chandler and Monica owe for calendar year 2018, is $858. Your case study materials provided a few other tax documents. So I have to ask, what about Chandler's conference expenses? Are they eligible for deduction on his return? Unfortunately, no. Had Chandler submitted the receipts and been reimbursed by Transponsor Incorporated, this would have been considered a job perquisite, just like healthcare or on-site daycare. As it were, these out-of-pocket expenses are exactly that for Chandler, out-of-pocket expenses. I also provided you the tuition statement from the Nowhere campus of Texas State University for Erica. Surely Chandler and Monica should have been eligible for some credits or some deduction because of their tuition payment. Unfortunately, the answer is no. Chandler and Monica make too much money to be eligible for either of these credits that begin to phase out above a certain threshold of income. Now, if you didn't get the $858 tax liability that I calculated, don't fret. Your grade will be based on completing the assignment, that is, completing all the schedules, as well as submitting answers to the questions that help me understand your understanding of the assumptions. Even if you missed an assumption along the way, or one of those silly things like checking a box for single or checking a box for the healthcare insurance, you won't be penalized heavily. As always, feel free to contact me if you have any questions, and I'll be happy to help. It's been a pleasure this semester, class, and I look forward to seeing you around town.